Hello, AP Macro students. Welcome to AP Daily Live. This is the fourth in this year's edition of AP Macro videos. And today we're going to be talking about T accounts and the financial sector. Every year that I teach this class, and I've been teaching a little while now, when we get to this part of the year, when we're prepping for the exam, there's always a few topics that come up, and T accounts is invariably one of those topics. It's a unique topic. It's a different topic. You could argue it's not even economics. So today we're going to take an in-depth look at T accounts, look at how they relate to the financial sector, and most importantly, how we can use them as a tool to explain money creation in the financial sector. My name is Matt Romano. I'm coming to you from Atlanta, Georgia, Marist School. And let's get started. Let's talk T accounts. So, as I said, what are we going to learn today? We're going to learn about T accounts. We're going to learn about T accounts within the context of the financial sector. And most importantly, learn about them as a tool that is used to help explain that money creation process. What skills are we going to practice? This is really important. Sometimes we neglect the skills. We get so locked into content that we forget we're really trying to develop skills in this class, skills that you're going to use well beyond the end of this course, well into your life outside of school. So the skills that we're going to talk about, first of all, just almost definitional. What is a T account? What the heck are we talking about with this thing? Being able to define what it is, being able to understand the different uses and applications of T accounts throughout the AP Macro class. We're going to explain money creation, as I've already said a number of times, both forwards and backwards, looking at how a particular action can create a certain amount of money, and looking backwards, what would be required to create a certain level of money creation. We're going to determine the effects of deposit expansion and money supply, and be able to take a set of data and make predictions and work through calculations based upon that. So let's warm up. We're going to warm up with just a little bit of definitional work. Again, what are we talking about today? And how do we wrap our heads around this thing, the T account? So three primary questions I want to start with. What is a T account? And then within the T account, what are assets and what are liabilities? And you can see here, I've got a generic T account label down here, just a nice, easy little picture. And it should be pretty obvious where the name T account comes from. And if it's not, just look a little more closely at the lines. A T account, if you want a formal definition, a T account is what depository institutions use to organize their assets and liabilities. It's a balance sheet. That's exactly what it is. It's a balance sheet. They don't only apply to banks. They don't only apply to depository institutions. That's the application that we're going to use in this class. T accounts are an accounting tool. They're accounting method. And frankly, I'm not qualified to teach you accounting. I'm qualified to teach you AP macroeconomics. So we could, if we wanted to go the accounting route, we could actually look at T accounts, not only for banks, but for private businesses. You could do a T account for the central bank, for the Fed. You could do a T account for your own household if you wanted to, and use that to better understand the balance between assets and liabilities. If we're going to do that, invariably, we have to know what assets and liabilities are. So let's take just a moment. Let's talk about that. And again, make sure we understand what assets and liabilities are. Assets, the left-hand side of the T account, as you look at it, represent items of value which are owned or controlled by whatever entity this T account represents. So in the context of AP Macro, we are looking strictly at bank T accounts. So when you look at the left-hand side of a T account, these are the items of value owned by the bank, controlled by the bank, which the bank is going to use to try to increase the overall value of that entity of the bank. So we're talking about bank reserves, loans, securities, plant and equipment, and potentially many, many more. These are the primary ones that we see applied in AP Macro. Individually, let's understand what these assets are. Bank reserves, essentially, the way we want to look at it, are the flip side of demand deposits. It's the money that banks have available to use in order to increase the value of their other assets. Assets such as loans. We know what a loan is. The bank has extra reserves, excess reserves. They lend it out to a private party or even potentially government in order to do something else. From the bank's perspective, that loan is an asset because that asset, that loan, has a future value, that future value, which is defined by the interest earned. And we're going to look at that in just a second through an application. Securities could be private, they could be public. Again, in the context of AP Macro, we are usually talking about government securities. And we're talking in the United States, we're talking about treasury securities. Securities, in essence, are another type of loan, but again, in a reverse order. So when you talk about government securities as an asset, the bank is actually lending money, in the case of government securities, to the treasury to help pay for the deficit. They do that because, just like in the case of a loan, they are paid interest on that money. They're paid interest on that asset. And then finally, plant and equipment can refer to any of that physical capital, that equipment that the bank itself may own in order to operate the business. Again, these are considered items of value because, for one, they could sell them and receive the value as payment. But number two, they help facilitate the business of the bank so that they can increase the value of other assets and do the business of a bank. On the other side, the flip side of the T account, we have liabilities. Liabilities are financial obligations. They are owed to someone else. And again, there could be a whole list of other liabilities on this bank T account. But in this course, because again, we try to keep it pretty simple, we really focus on two bank liabilities. Number one, demand deposits. Number two, owner's equity. Demand deposits refers obviously to money deposited by the customers of the bank. These are checking accounts. These are savings accounts. This is money that is owed back to depositors whenever they want it. That's why they're called demand deposits. This is where banking begins. You can't have anything on the asset side, and we're going to look at this with some numbers, if you don't first have something on the liability side, specifically on the deposit side. Without deposits, there really isn't a bank. There's no business to be done. Owner's equity, which we'll get to in just a moment, a little more specifically, refers to essentially the return back to the owners of the bank, the equity, the amount of ownership returned back to the bank itself, to the owners of the bank itself. And what we're going to show here is that, as illustrated on a T account, the most basic interpretation of a bank's business model is to take demand deposits, treat them as assets, as reserves, increase their values so as to create owner's equity, a return back to the owner. And on that point, I just want you to keep one little thing in mind. Banks are businesses. And when we say that, we have to consider the incentive behind starting and or owning a bank. As a business, just like any other type of private financial investment, the starter of the bank, the owner of the bank, is seeking a positive return. We see this all the time. We see it all the time in AP Macro because, again, economics is all about why do we do the things that we do. So why do owners start the business of a bank? To get a positive return. Well, that owner's equity represents the potential positive return of those owners. So the most simple, again, explanation of what a bank is trying to do is to take demand deposits, increase their value as assets, and the return goes back to the owners. That's the business model. Again, in real life, it's much more complicated. You get into high finance and a whole lot of other things, but that's the most basic interpretation out there. Let's look at examples. This is a whole lot easier when you just get your hands dirty and start working with it. Trying to describe it, trying to define it, it can be a little complicated. If we just start working through the numbers, it starts to get a whole lot more clear. So let's look at an example. Let's say you're opening a bank. Today is day one at your new bank. At your new bank, we have a reserve requirement of 10% as set by the central bank. Let's just start with that assumption. Right here, we have an empty T account. Nothing's going on. The first thing we have to do in order to have a bank is we have to convince someone to deposit money in the bank. So let's do that. Start with deposits. Now, when deposits enter the picture, when we first enter deposits on the liability side, the next thing we're going to do is we're going to apply ALLO. ALLO is an accounting expression that it means that represents assets equals liabilities plus owner's equity. Keep that expression in mind. In fact, every time you do a T account question in macroeconomics and AP Macro, it'd be a good idea, just as a reminder to yourself, to write down the word ALLO. Assets equals liabilities plus owner's equity. So always apply ALLO when you're working with the T account. The way that would look right here, let's assume you convince people to deposit money in your bank, and the result of those deposits is that you start with $1 million in deposits. That's on the liability side. That's demand deposits. That is reflected on the asset side as $1 million of reserves. Now let's pause right there. Let's think about why that is and what that means. The nature of a bank, as I said, it's a business. It's not just a place that holds your money. It's not a charity. It's a business. When we put our money in the bank, whether we say it out loud or not, we are implicitly allowing the bank to use our money. That's the agreement. And we need to know that. So while we view the money in the bank as a deposit, the bank views that same money as bank reserves, total bank reserves. And that's what this is showing us. So we have equal amounts on both sides of our T account. You have $1 million in deposits, you have $1 million in reserves. Now, given the conditions we have here, they can't lend the entire $1 million, but they can lend most of it. That's because we have what's called a fractional reserve system. And again, that's an important point when learning about the financial sector, money creation, and the way all of this works as we start doing these problems. Those bank reserves can be divided up between required and excess reserves. So in this example, given a reserve requirement of 10%, we can conclude that this bank has 90% of demand deposits available to lend. The reserve requirement means they have to keep 10% of demand deposits in the bank as reserves. So in this example, demand deposits are $1 million, total reserves are $1 million for now. They haven't done anything yet. Of that $1 million in reserves, they have to keep 10%, $100,000 on reserve. The other $900,000, they can lend it out. So let's talk about the lending process. The bank decides they're going to lend out some money. Let's say they lend out $400,000. Now, why would they do that? That's the basic business of a bank. Why would they choose to lend the money they have on reserve? The most obvious and basic answer is to earn interest on that loan, that financial asset, which is in turn going to increase the value of assets so that they exceed liabilities, therefore creating owner's equity. So in this case, the bank lends $400,000. We made a change on the asset side. They had $1 million in bank reserves, total bank reserves. 100,000 of it they had to keep on reserve based on the 10% reserve requirement. The other 900,000 they could lend. They lend out 400,000. Maybe someone's buying a house somewhere. They lend out the $400,000. Okay. Maybe it's multiple loans that come out to $400,000. Hard to say, but for whatever reason, they lend it out. Now they have a separate asset, loans, which are of a current and future value. The current value is what the money that they lent out already. The future value is what they get in return, the money paid back plus interest, because that's the deal when we borrow money. We pay the money back plus interest. Let's just say now some of that money gets paid back. Let's just say that whoever borrowed a portion of that money is paying the money back plus 5%. And we're fast forwarding through time here, and I tried to make the numbers pretty simple. They pay back $10,000 plus they pay back 5%. They pay back $10,500. So the $10,000 that was borrowed turns into $10,500 in reserves, increasing the overall value of assets. Now, go back 2 steps. What has to be true when we look at a T account? We always have to apply ALO. Assets must equal liabilities plus owner's equity. When I look at assets now, because of that interest payment, when the money was paid back, assets now exceed liabilities. They exceed demand deposits. By any amount with which your assets exceed your other liabilities, that amount becomes owner's equity. And as I've already said a number of times here, that development of owner's equity, that's the most basic function of the bank as a business. Take those assets that started with demand deposits on the liability side, take those assets as bank reserves, turn them into assets of higher value so that your asset value goes up, therefore creating owner's equity. Now, in this course, we don't deal with those kind of questions a whole lot. It can come up from time to time, but we don't do a lot of those. I did all that just to establish a slightly better understanding of what a T account is and what it's supposed to represent in the context of banking, in the context of the financial system. Have that in mind as you work through money creation problems. Have that in mind as you look at assets on other T accounts. Why did the bank lend the money? To earn interest. Why did the bank buy securities? To earn interest. All towards trying to build up that owner's equity. All of that we can understand better from a T account. And that's the purpose of using them in AP Macro. No, we're not going to become accountants. If we want to become accountants, we need to take other classes, and that's perfectly fine. You're not going to become an accountant from what you learned in AP Macro. You can use an accounting tool to better understand macroeconomic activity. That's the purpose of the T account in this context. Okay, so enough talk about definitions. Let's practice. We need to see this in practice. Sometimes it's a whole lot easier when you can just start applying the lessons as opposed to talking about them. So let's look at an example. Example here shows a T account for the Bank of Dunwoody. As you can see, the Bank of Dunwoody has $800,000 in demand deposits. That's their total liabilities at this time. ALLO applies. So reserves plus loans are your assets. They come out to the total of $800,000. Now, the first thing that we should always be able to calculate just on our first glance is how much money this bank has available to lend. And you can see I've got there in green, the number is $520,000. That's how much they have available to lend. But where did that number come from? It's really a simple little equation. The reserve requirement of 10% simply means that the bank has to keep 10% of demand deposits on reserve. They have 600,000, 80,000 of that, 10% of demand deposits, must be kept on reserve. The other 520,000, that's what's available for lending. Don't confuse this with the other category I have on here, loans. That $200,000 in loans, that money's already gone. Someone's already borrowed that money. It's out the door. It'll come back plus interest in order to build owner's equity. That's an easy mistake. Let's not do that. Second thing, just by glancing, we should be able to do, what is the maximum change in money supply that may result throughout the banking system through lending activity this bank? That's going to be $5.2 million. That comes from this equation. The maximum change in money supply is equal to excess reserves times the money multiplier. We just established that excess reserves are 520,000. And with a reserve requirement of 10%, your money multiplier is going to be 10, 1 over 0.1, which equals 10. So every time we look at a T account, these two things we should be able to calculate, again, just at a quick glance. Now, what specific scenarios and questions can come up as a result of all this? I'm going to go through a series of 4 questions. I'm going to propose the question, and they're all related, and they're all very closely related to questions you will see frequently on AP exams. I'll propose the question, tell you to pause the video, do the question, find the answer, come back to the video, we'll discuss the answer. So here's the situation. Assume a reserve requirement of 10%, just like we had in the previous example. Sadie deposits $10,000 cash into her local bank. Calculate first the immediate change in bank deposits resulting from Sadie's deposit. All right, pause. Okay. The immediate change in bank deposits resulting from Sadie's deposit, very, very simple. Not a whole lot to even say about that. Bank deposits are going to go up $10,000. I know that's simple. That's almost insultingly easy. It's going to come back to us soon, so keep that in mind. Second question. The immediate change in excess reserves at Sadie's bank. Okay, pause, answer the question. The immediate change in excess reserves at Sadie's bank is going to be $9,000. Now, let's again make sure we understand why that is. Sadie deposits $10,000 in the bank. That's on the liability side. That's on the right-hand side of the T account. Okay, understood. That $10,000 must be represented on the left-hand side, on the asset side. The $10,000 is total bank reserves. However, of that $10,000, we know that $1,000 they can't do anything with. There's a 10% reserve requirement. $1,000 is kept, it's not literally kept separately, but in our minds, the $1,000 is separate as required reserves. The remainder, the other $9,000, that's excess reserves. That's the money the bank is able to lend. Don't lose sight of that. That's important. Okay, so first two questions done. Those are immediate changes. Pay attention to that wording, because again, you're going to see different types of questions, different types of wording. Immediate change says she put in the money. What happens next? What happens right away? Now let's talk about down the road. What's going to happen over time? Calculate the maximum potential change in money supply resulting from Sadie's deposit. So this isn't what happened right now. This is what happens down the road. Assume banks are going to lend all excess reserves. Assume borrowers are going to redeposit all that money. Go and calculate the maximum potential change in money supply resulting from her $10,000 deposit. Pause the video, then come right back. Okay, so what's the maximum potential change going to be? It's going to be $90,000. Why? Well, use that formula I gave you earlier. The maximum change in money supply will be excess reserves times the money multiplier. Sadie deposits $10,000. That $10,000 created $9,000 in excess reserves at the bank. We take that $9,000 excess reserves, multiply it by 10. Sadie's $10,000 deposit could potentially create $90,000. Again, assuming all excess reserves are loaned out, all loans are redeposited in the banking system. As soon as it says maximum potential, we know those assumptions apply. Finally, one more question, closely related, but not the same, and it's easy to confuse these. Calculate the maximum potential change in demand deposits resulting from Sadie's deposit. Okay, so again, stop, center yourself and think, what are we looking for? We're not looking for just the change in money supply. We're looking for the total change in demand deposits. Pause the video, answer the question, and then we'll go over it. Okay, so the maximum potential change in demand deposits resulting from Sadie's deposit, $100,000. Now, you can, if you're comfortable with it, it is okay in a question like this to simply take that initial $10,000 deposit, multiply it by 10, the multiplier, and get your $100,000. But I think it's helpful to break that down a little bit more and consider why that's okay and why the answer is $100,000. What's actually happening here is that the $10,000 deposit, it was cash, now it's deposited. That $10,000 deposit created another $90,000. And because we're going maximum potential, we are assuming that it all gets redeposited in another bank somewhere or the same bank. So just the money creation process created an additional $90,000 in demand deposits based on our assumption. In addition to that, though, we can't forget the original $10,000. Those were new deposits as well. So when it's all said and done, the $10,000 deposit increased total deposits by $100,000. The $90,000 that was created plus the initial cash deposit of 10. Don't forget that initial cash deposit of 10. Okay. It's such a subtle difference, I know, but these are questions that historically have given a lot of students a lot of problems, and it helps to think through why the answers are what they are, not just memorizing formulas. Why is that the formula we use here? Why is that the correct answer? You're going to be in much better shape come exam time if you take a little bit of time to do just that. All right, finally, what should we take away? Just a quick little review, quick little debriefing of what we've covered today. T accounts, first and foremost, are an accounting tool. Let's not lose sight of that. It is a tool. It's really not an economic theory. It's something we use to understand the application of economics. How and why do we use them? We use them to understand a bank's balance sheet. We need to understand the place and role that a bank plays in the financial sector and in the broader economy. But we also use them to simulate and to make predictions of money creation and deposit expansion. Okay, I want to thank you for watching today. I want to thank you for tuning in to AP Daily Live. I do hope that you learned something. I hope that you learned a little deeper understanding of what a T account is and how T accounts are applied. And I'd request you come back and watch the next video. Thank you very much, and hope you have a great day.